Welcome to Jazz After Dark, everybody. How you doing out there? Tonight brought to you by Buffalo Trace. Just a little bit. You know what I mean? Hope you all are ready to have an incredible Independence Day. If you are unfortunate enough not to have bought any fireworks, can't afford them, don't participate in that, feel free to stop by the Tibbetts residence. We are going to put on a full-on show. I mean, like, we have fuses lined up and they're all connected to different things. We got Velcro on the, the stuff so it doesn't, blow up our house and stuff. Side topic. Hey, we're going to talk about the news here tonight that you may have missed while you were out there buying fireworks and doing your thing, maybe on a summer vacation. I'm kind of liking this thing here on like Mondays, just going over stuff that maybe wasn't front and center to you. What was front and center to you was the student loan payment thing. So we talked about this with clients in our Wine and Wealth class. We went through it's probably going to get rejected. It's not really because we don't want to pay off the student loans, but because the president really doesn't have that authority and he can't set that precedent now. And then maybe a Republican becomes president, wants to do something, and they're just going to fight them. And, it's this big distraction thing. But student loan payments are actually coming back in here. There's an article that from Market Insider that cited a Morgan Stanley study that says, 34% of borrowers say they're not going to be able to make their payments on their student loans. Well, okay, this is a passionate topic, and I understand that some of you are going to highly disagree, but the data is the data here. And so what they basically are citing is just a handful of things, and I'll share some data with you. 29% of consumers who have federal student loans are confident that they'll have enough money to make the payments once they restart coming up here next month. 37% said, well, I'm going to have to cut my spending in other areas to make these student loan payments. Well, yeah, that's what happens when you don't have a payment for 3 years. You get kind of used to not having it, right? I mean, I would fall for that too. 34% said they're not going to be able to make the payments at all. This is a Morgan Stanley study. I believe there was 2,000 people. Average debt payment was between $300 and $400 a month. Some people couldn't even remember what their payment was. Look, we know that if you look at the PCE data that was actually just revised the other day, it shows that you are spending more on products and experiences, services, bars, restaurants, things like that, things that aren't physical, than ever before. And so, yeah, you've gotten accustomed to not making the student loan payments, and it's time to make some adjustments. However, the argument of, well, it's the low-income people, that's not fair, they can't afford it, that's actually not true, and you can use the Department of Education, the Federal Reserve, to come to that data. Let me just share a few things with you, and then we'll move on from the obvious. We're about $70 billion short, meaning there's $70 billion that's not being paid at the moment, and this is from COVID, right? So we were on track to just be an incredible sum of money here. COVID hit, we start delaying, pausing, and then freezing the payments. So that's not new news to you. Here's the issue. This is all the incomes for student loan, the people that have student loans, here's their income breakdown into groups of 5. It's called quintiles. And so the bottom income group, now, we're going to go over, get rid of the blue for the moment. I shared this before because we know that's not possible. The blue would have been if the Biden proposal was passed. So it's not. So we're only using the gray here. The first thing is the red diamond up here shows the percentage of people in this column that have student loan debt. So you would take this, you'd follow it off to the right there, and you'd see, I'd say 12% of people in the lowest income category have student loan debt. This is not my data. I'm not making this up, so hate me if you hate it. And we're using the last date available, which was just before they paused the payments, right? Because it's not a factor at the moment. All right. And then, so the gray area here is the student loan payment as a percentage of income. So roughly 0.5% of their income has been borrowed for student loans. Notice what happens as you work your way into the middle income, upper middle income, above average income, high income. There's a shift, right? Or there's sort of a parabola. No, there's an arc, right? The majority of people that have the largest sums of student loan debt have income to back it up and would not have been eligible for the Biden plan anyways, because remember, the Biden plan says if your income was over 120,000, 250,000, married filing jointly, then you didn't qualify anyways. You weren't even going to get some of that student loan debt released. And the people in the bottom part of this income, 90% of them have taken up or qualify for the income-driven repayment plan. So they're already getting assistance. So what, if anything bothers you about this, it should be that, hey, we were going to really help the middle income people here. The people that, yes, they could have cut back on some of their spending and made their student loan payments. They were just answering that survey and just is sort of like, I don't know, not being honest. That has been turned over left and right. If you look at the Supreme Court case and look at the arguments that they made, some of them were sort of silly, like when they said the press secretary literally said you have to pay your student loans. Okay, that was kind of funny. But most of them were citing the fact that the low-income people are already getting forgiveness. The $70 billion that you're trying to forgive is for the middle and upper middle class of people who just need to change their finances to make payments on things. You can't make the inflation argument and all that stuff there. By the way, if you want to know the numbers of who those the dollars were, I went to the Department of Education and got this. Here's the 5 brackets that we were just citing there a second ago. If you're low income, your annual income is up to $33,700 per year. That is low income. That's fair to say that's low income. This is a single individual borrower. They don't look to see whether you're married or not. You're carrying a great portion of student loan debt. So your payments are going to be a good portion of your income there. As you work yourself up, here we now find ourselves into category 3, 4, and 5, where at the upper end of 3, 4, and then 5, you weren't going to get any forgiveness anyways. And so you can afford, or they claim you can afford to make your student loan payments. So it's a really, really tough argument to make there, and I'll move on from the student loan stuff. I'm careful where I tread there because I know some people, are still going to be on the side of forgive student loan debt. But when we're done with that, I'd like to forgive the loans on my house would be great, and we could take care of that. Oh boy. All right, next in the news here, the SEC. So for a while, the SEC has been hearing the NASDAQ, the CBOE, and maybe somebody else. They want to come out with what's called a spot ETF for Bitcoin. In other words, they're saying we want people to be able to buy a direct ETF for Bitcoin. You know how the GLD is a spot ETF for gold. In other words, it tracks gold minus the fee, which is negligible, right? So wherever gold goes, the price of gold, so goes the ETF. And that's a way for you to participate without going and buying physical gold or participating in gold futures, which was previously your second option, your only option aside from physical gold. Well, they want to do the same thing with Bitcoin. And the SEC says, no. The SEC said that these applications were insufficiently clear and comprehensive. And therefore, you can refile, you can try again, but they're just not very clear. So that's one of those where you'll read the headline and go, oh, shucks, better luck next time. How can an ETF application based on a specific spot price, just all we want to do is track that price, like the S&P index fund, we just want to track the S&P. That's all we want to do. That's pretty clear. We just want to track Bitcoin, whatever it does. That's pretty clear. The SEC has been playing hardball on this one, nonetheless. So I just thought that might be something you'd like to know. Okay, what else do we got here? Oh, I got a funny one here coming up. Just give me a second. Let me go over this one first. I've got a real funny one in a second. Maybe kind of financial related. Okay, one of the things that's been sort of buried in the headlines is bankruptcies. Business bankruptcies, corporations going bankrupt. There's bankruptcies and there's defaults. So far this year, did you know that there's been 324 bankruptcies filed? You might know some of them. Bed Bath and Beyond being one of them. SVB Bank, being another one that was a tough one there. 324. Well, it's halfway through the year. All of last year, we had 374 in total. We're halfway through the year with 324. And the Federal Reserve is saying, yeah, there's going to be a little bit of distress here for you guys because of our tightening. But if that were front and center in the headlines, the stock market would be falling apart. So we're on pace to nearly double the amount of bankruptcies that we've seen. And yet that's not really making any headlines there. The cost to borrow for distressed companies right now is anywhere from 9 to 13%. Well, if you're barely making a profit, that's going to hurt you a little bit. The number of defaults, those that have defaulted on their actual loans, is 41 this year so far. That's already double what we did last year. So that's not good. So a tough one there, and a ding for, hey, the economy's strong. Yay, it should be fine. I don't know. The Fed actually publishes their own data. They cite distressed companies, the number of distressed companies that are out there during a tightening cycle. So in red, what they did is they highlighted, this is the last time we tightened, this is the current time we're tightening, here's a time, here's a time, here's a time, right? So they're showing when they've raised interest rates, how did it affect companies in terms of becoming distressed? And so we are almost to 2008 levels of the amount of distress that they're putting on companies financially, which is an argument. You might say, oh, poor companies, the stupid rich people. That's not a nice answer to say. But yeah, this, just like your student loans causing distress, you got to change the way you operate your personal finances. Well, these high interest rates are actually starting to hurt companies as well. A bit of a shame there. Okay, last one. Check this out. I just thought this was funny. You know what I mean? Okay, so this lady from Harvard, here's her, this is who she is. Dr. Francesca Gino, a Harvard Business School scholar. Her focus is on honesty. So that's her thing. She looks at studies of how honest people are in insurance claims, tax filings, and all kinds of stuff. When it comes to money, she looks to see the level of honesty that is found inside of this. I'm not sure how you do something like that. Anyways, Dr. Francesca Gino from Harvard, her coworkers said, some of this isn't adding up. This is very bright people at Harvard. She's obviously very bright. The other people are looking at it and they're like, Francesca, we've found some evidence that you're manipulating the data and not actually being honest. She was actually falsifying data in her published studies. And if you look on Harvard's website, she still has a job. So, okay, that's interesting. Good job. I don't know how you do that. Anyways, just some of the fun things that you may have not seen. There's all kinds of good stuff there. I don't know if it's interesting to you, but if you look over in China, manufacturing in China has declined for 3 straight months in a row. They were supposed to be expanding. That is not happening over there. The LIBOR has been officially retired. Have you noticed that? If you look at your home equity line of credit or any line of credit that you have, it used to say some premium over LIBOR. That's officially been retired because it's not credit sensitive. And there's actually a big flaw there, which some traders figured out years ago and were able to make a bunch of money, illegally, by the way. But they said, so now we're going to do it to the standard overnight federal rate, the rate that banks borrow from each other for. And so there's some arguments there because that's not credit sensitive either. And the standard overnight federal rate, or the SOFR, which you're now seeing on your statements, is not really accurate when it comes to financial situations because it could be, fun story. I'll just wrap it up with this little history lesson, since I'm, of the age where I can give history lessons, right? In the 80s, when I was just a little tiny one and walking around in diapers, we used to use the T-bill as the benchmark for this, right? For risk. So we would say you're going to pay 3% over the current T-bill rate. And so they said, well, that was our benchmark. That's how we figured it out. So when you looked at your statements, that's what you saw. Line of credit on your home, it was 3, 4, 5% over T-bills. Actually, at that point, it may have been higher than that because rates were higher. Well, then what happened? We have this big economic sort of pullback, right? The markets cater, the big 1987. I can't think of Black Tuesday or Black Mondays. I can't think of it at the top of my head. So we have this big problem. People get scared of the stock market. Where'd they go? They went into T-bills. When you buy T-bills, the price goes down. I'm sorry, the price goes up, the yield goes down. So now what happened? Your line of credit was, let's say, 5% over T-bill, the current T-bill, and it was a short-term T-bill that they used. So we say, okay, it's 5% over that. Well, when the world started buying T-bills and prices went up, the yield went down. The yield on your line of credit went down. The bank was taking excess risk, right? And they weren't getting paid for it. So they said, oh, that doesn't work. That sucks, man. When people go buy bonds, or T-bills in this case, that causes the rate to go down, which means people are actually paying less for the line of credit that they have in a more risky environment. So they said, we don't like that. Let's move to LIBOR. And that's how that changed over time. Well, the troubles there were that that's not credit sensitive. So the banks were starting to argue, and they were saying, well, here's the trouble. That doesn't reflect our borrowing costs. That's just the rate. And so our actual costs are higher. And so when we tell somebody it's 3% over LIBOR, that's not totally accurate because it costs us money to put these things together and facilitate compliance and all that stuff. And so they've been arguing that. Well, then some quants and analytical people on Wall Street figured that out, got in a whole lot of trouble. They had fined like $11-12 billion. It was something ridiculous. And so they've been making this change back to the federal rate, overnight rate. Well, people don't like that either. So the argument right now in the world, if you're curious about finances and what people talk about in the big, tall buildings in New York on a daily basis is, why does there have to be one? We don't have one credit score, do we? We have 3 credit scores. It would be dangerous if we had one company control the credit scores. So they're arguing that there should not be one, either SOFR, LIBOR, T-bills. It shouldn't be that way. We should be able to use the benchmark that we want, and smaller banks could use a risk-based benchmark instead, maybe a combination of both, because they're more at risk. They're potentially making slightly riskier loans, and the bigger banks don't do that as much. Was that horribly boring? There's my history lessons. If you had a chance to have a drink, then great, you learned something different. And unlike Dr. Francesca Gino, that's accurate. I'm telling the truth on that one, not making up that data there. All right. If you like this sort of thing, let me know, because I have like 2-3 dozen different headlines here. I don't know that it's that interesting to you, but happy to do it if you like it. Otherwise, let's see what this week has to offer. And in the meantime, I'll wish you a great and happy Independence Day. Remember, the stock market is officially closed tomorrow. We'll be back on Wednesday, and enjoy. Make sure you light the firework, run away, right? Light the firework, run away. Just kidding.